This graph shows what the futures market profile for the RBA cash rate was yesterday morning. And this is what it looked like this morning. Almost all of the rate hike expectations have been removed. And the consensus now is that rates will stay on hold for about 12 months, with the next move being down. Now, those who think rates should be cut call this higher for longer. Those who think rates should go up call it lower for longer. And as always, different opinions make the world go round. The Aussie dollar slipped further below 66 US cents today, and the share market saw stronger retailers offset by weaker miners, while banks were mixed. Stocks in London went up. In New York, they went sideways and down in Tokyo. And on commodity markets, gold, iron ore and oil went down, while copper went up. Now, along with its interest rate decision yesterday, the Reserve Bank published its quarterly statement on monetary policy, which contained a pretty hefty discussion of the output gap. And it's worth outputting a summary of it into your lounge room. The output gap is the difference between GDP, or output, and the Reserve Bank's estimate of potential output. If actual is greater than potential, then inflation happens, because the economy is exceeding the theoretical speed limit. The good news is that the gap is getting smaller, but for the Reserve Bank to be comfortable and relaxed, it needs to be zero. But what the RBA is really worried about at the moment is shown in this graph. Unit labour costs are shooting up while productivity is not. To keep interest rates where they are, productivity needs to not stay where it is. And that's finance.